Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. We got some economic data today on the inflation front. PCE, the smart folks look at that core PCE index month to month, up 0.3%, right in line with expectations. On a year-over-year basis, 2.6%, again, right in line with expectations and a little bit lower than last period. That's the number, it's one of those numbers that the Fed would like to see closer to 2%. So maybe a little bit more work to do there. Priya Misra joins us, fixed income portfolio manager at JPMorgan Asset Management. Priya, what did you make of the inflation data? And more importantly, how do you think our friends at the Federal Reserve are going to view this data?
So I think the Fed realizes that inflation is above target. They'd like it to be closer to 2%. It's at 2.6 year over year. So there's still more room for it to come down. But when we look at the details of the PCE report, we are seeing improvements across the board. There are a couple of components that are high, but they're heading lower. So I think it's good news, came in kind of as expected. It tells us that the Fed is in no rush to cut rates and they're going to stay on hold. We're actually, I think the market's focus is moving away from inflation now more to growth and all the policy uncertainty. But at least it was good news in the sense that it didn't pick back up, which was a concern late last year that inflation may be reaccelerating. I think we can put that fear aside. Now I think the fears are shifting to the growth side.
The Atlanta Fed GDP Now tracker, Q1 GDP growth now forecast at negative 1.5%. I mean, that's recessionary territory. Your take on that?
I think today's trade deficit came in so much weaker than people were expecting. We've heard that the gold imports from the rest of the world is one of the factors. So I'd say it's less about like a big slowing in growth, if it's all driven really by trade. But, I think the market is reacting to the fact that there is policy uncertainty. There's tariffs. We know tariffs are a stagflationary shock. What is DOGE doing? So I think there are growth fears. I would put aside some of the Atlanta Fed recession fears. I think the hard data so far, tier one data, and we're going to get a lot of it next week. We're keeping a very close watch on the labor market, particularly. The hard data has been tier one data has been still strong. I think where the concern is some of the sentiment data, business uncertainty indices are picking up. I think, does this weigh on business investment, business hiring? That's the question mark. I think the market's pricing in that side of the distribution, the growth risk side of the distribution, which I think the market was not really concerned about the last few years. That's picking up. But I would ignore the Atlanta Fed. I think we're not close to a recession. Let's see how the actual data is turning out. You have to do the seasonal adjustment, make sure you're accounting for what's happened with the LA wildfires. Let's look at the actual data when it comes out. I would say the economy is okay, but there are downside risks that are building. And that's why I think you're seeing the rates market react the way it has the last few weeks.
Yes, we've seen rates come in here. So Priya, for your portfolio, what kind of changes, if any, have you been making recently?
So we were leaning long duration, closer to 4.25. We actually think duration looks fair. Now, if the tier one data starts to show things weakening further, then at that, we may be looking to go long duration. I think rates look very fair here. What we've been doing, though, is moving up in quality. So within our credit spectrum, trimming a little bit of high yield, moving up in quality investment grade, just because with uncertainty, maybe it stays in the uncertainty mode. Risk premiums should be higher. And we should get paid to take that extra risk, which we don't think you're getting paid necessarily in every segment of the market. So we're looking at the portfolio, particularly the credit part of the portfolio, very closely, moving up in quality, making sure that the companies, the sectors we own are less sensitive to some of the headline risk that's out there. So just doing more of that credit work, but staying with it. I think we're in a soft landing. And so, when the 10-year was closer to 4.5, it was attractive to own duration. I think at this point, we can be neutral duration and be careful with the spread product that we're buying.
The administration is talking about tax cuts. Can I ask you how much in tax cuts can this bond market stand?
I'm glad you bring that up. I think the expectations of tax cuts were much higher a month ago. And I think the market realized that the administration has a constraint, both politically as well as a market constraint. And I think expectations of those tax cuts have come down. You see the House passed bill. Let's see what the Senate does with it. But I think our expectation is all we'll really get is an extension of the 2017 tax cuts. That's not net new stimulus. Now, that does increase the deficit, but I think that is priced into the bond market. So we're not expecting, and I think the market's priced for not a whole lot more in terms of tax cuts. I think we're going to spend all year trying to find those pay-fors, making sure that, we can at least just extend that 2017 tax cuts. I don't think we're getting any more tax cuts because, to your point, the bond market is going to push back. And we know the president, Secretary Besson, they care about the 10-year. They realize that the 10-year impacts the economy, it impacts risk assets. So I don't think they'll be able to get much because it's going to be tricky. Where do you get those spending cuts to offset? Just the extension of the TCJA is $4 trillion in deficit. So I think all we'll get is that extension. And I think that's in the market.
All right, Priya, thank you so much for joining us. Priya Misra, she's fixed income portfolio manager over there at JPMorgan Asset Management, joining us from New York City.
Did she just say
thing.
I'm not getting a SALT tax deduction raised?
I think that's still on the table, but I don't know. We'll have to see. That's a lot of the tri-state lawmakers said, we're not voting for anything unless you put that SALT thing back in there to some degree.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
John, as you know, the White House, as for every president, puts out a daily schedule for the president, what meetings he has, and so on and so forth. He'll be jetting off to Mar-a-Lago this afternoon, and I would do the exact same thing. I mean, it's cold. Go down to Florida, man.
Why not?
I mean, I played that golf course way, way, way back in the day. It's pretty good. So why not go down there and play some golf, jump in the water? I would do the same things, particularly if I had a jet in my disposal, like Air Force One. Why wouldn't you?
Well, Truman called it the Winter White House down in Florida.
Okay, very good.
Is
I'm all in on that.
Mar-a-Lago? Yeah,
I don't know. All right, let's check in on what's happening down in D.C. because, again, Mr. Zelenskiy is scheduled to be at the White House this morning, right now, as we speak, speaking with President Trump. Dr. Ariel Cohen joins us. He's a senior fellow at the Atlantic Council. Ariel, realistically, if you're Mr. Zelenskiy, what are you hoping to achieve today?
I would try to get as much or as many security guarantees from the United States and also put on the table the following. In order to keep Russia at bay, if they go to a ceasefire now, or maybe eventually to a peace treaty, they will need about 10 brigades of peacekeepers in Ukraine, well-armed and potentially backed up by the NATO nuclear umbrella. This is the conversation that needs to happen in the Oval right now. Anything short of that, Zelensky is giving Trump something which is very vague about critical minerals, rare earth. We don't know where they are. Some of these rare earths are under Russian occupation in the eastern Ukraine called Donbass. And in the end of the day, the market for rare earths is $3.5 billion. 65% of mining is dominated by China. 85% of processing is dominated by China. So we're not talking big bucks. If, on the other hand, Trump tells his audience, his electorate, look, I got this wonderful agreement. Now we need to back Ukraine. That is a Trump political, domestic achievement. And if that's where he's going, more power to him. But in the end of the day, the long-term American interests do not change based on who's in the White House. We, the United States, have an interest in keeping Russia out of Europe, keeping Europe from being dominated by one hostile power, being Nazi Germany or Kaiser's Germany or the Soviet Union or Russia. And as long as Mr. Trump keeps that in mind, he can run with that policy and do whatever he wants.
Is there a historical precedent for getting something like a mining deal or whatever it is, metals deal, in exchange for, we'll protect you now? Sounds a little like extortion.
I did not hear the language of exchange for protection. What Trump is saying
it's kind of implicit.
No. The United States, Trump says, gave Ukraine assistance. There's a huge debate how much. Trump said 500 billion, then he said 300 billion. The Europeans did the calculation and said, it's more like maybe 120 billion. And the Europeans are saying they gave as much. But Trump is trying to recoup that assistance with this deal. In 1,000 years, that particular deal is not going to provide the U.S. with 120 billion. And Trump is not talking about security guarantees. And the precedent I'm thinking about is Franklin Delano Roosevelt, by all accounts, one of the greatest strategists, maybe the greatest strategist sitting in the White House since George Washington and Thomas Jefferson. In 1940, when Britain needed these naval destroyers, gave them 50 naval destroyers from World War I, older ships, in exchange for 9 naval bases in the Caribbean and Newfoundland. So it was basis for destroyers deal. The destroyers were not for free. And this was the beginning.
But that was sort of to appease the isolationists in Congress, wasn't it? It wasn't.
Well, we have isolationists in Congress right now.
Yes, we do.
And the MAGA electorate, America First, is the same slogan they had back in 1940.
Ariel, if you're President Putin, how do you think he views what's unfolding, A, in the United States White House with President Trump coming into office, and then, the need for peace at some point? How do you think, where's Mr. Putin these days?
It's a great question. Putin always puts up this, gamer face, poker face, and says, oh, Russia is winning, we're doing so great. In reality, there are reports now that they're sending soldiers on crutches back into front line. They're using some donkeys instead of trucks. I don't know how true that is. They try to use North Koreans. We saw this is not going anyplace. They're reaching out to Nepalese and the Cubans to send to be killed in the front line. They're not gaining a lot of Ukrainian territory, although Ukraine, population-wise, is 5 times smaller than Russia? Economy-wise, maybe 7 times smaller than Russia? So Ukraine is putting up a heroic fight, but the fight is not about Ukraine. The fight is about European security and ergo, therefore, the balance of power in the world. And to keep that balance of power, to keep hostile powers such as Russia and China away from Europe, this is an American interest, but it's also in our interest that our European allies start putting their big boy pants on and paying up, because the Europeans were not sustaining their fair share in NATO defense. Barack Obama and Joe Biden kept telling them that. Donald Trump has a different style.
What kind of shape is NATO in right now?
NATO is not having fun because the European and the American military-industrial production is matching what our needs are. And our needs are not only Ukraine, but potentially China. Therefore, the defense stocks were doing very well and probably will continue doing well, not only because of Ukraine, but also because of the Pacific. The Europeans need to get their act together. NATO needs to get their act together. And once they think, and Trump wants them to think that we're pulling out, Britain, Germany, and France should find their way to manage NATO in Europe and to lead both on the military-industrial front and on the manpower, on personnel front. Can they do it? That is the $64 billion question.
Ariel Cohen, thank you so much for joining us. Ariel Cohen, he's a senior fellow at the Atlantic Council, joining us from Washington, D.C. Via Zoom.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Like most investors, I think we're all just trying to, kind of sift our way through all the news that's out there, particularly coming out of Washington, fast and furious. And what does it all mean for markets when you try to find the stuff that really matters? We had some economic data today. We have earnings, of course, finishing up, but we've got a lot of news coming out of Washington and other parts of the world. Peter Tchir, he's head of macro strategy. He tries to do this as well. He's at Academy Securities. Peter, what do you tell your clients on kind of how to navigate through a lot of the noise that's out there in the marketplace?
I think we're trying to figure out what's the theme that's coming out of this administration. That's still a little bit unclear. And then, okay, what can we ignore? And more, I think where we're getting stuck at is basically, even if you believe we're going to have good outcomes, or you might believe we'll have bad outcomes, I don't see how we don't go through a bumpy patch first. So that's kind of my current view, is everything that's going on is going to lead to a slowdown in the economy, either because we do things to the economy or because of the threats of what we might do. It slows the economy down as people kind of put themselves on wait and see. So I'm now a little bit bearish on the economy, and I think markets because of that.
Lisa just gave us the Bitcoin quote. It's right now, down 0.3. It's around 84,000 per token, which is kind of a precipitous drop from the high. What, if any, risk does crypto pose to stocks, my stock portfolio?
I think it has been posing a greater risk than it used to. One, there's always the wealth effect. So I think the wealth effect is real. So if crypto continues to go down and all the altcoins, which have been hit particularly hard, you'll have a wealth effect. But the other thing is, I think really since the advent of the ETFs, you used to have people who were in crypto and they held it, say, in cold storage, or maybe they held it at Coinbase. Now they might have it in their, Fidelity, Schwab, wherever you do your brokerage account, and it's mixed in. So I think when they see their crypto ETFs go down, it makes them respond and possibly sell everything. So that's one part that's very different from even a year ago. And the second part is that MSTR itself, they become even more wed and tied to crypto, right? Every single day they talk about their Bitcoin yield, whatever that is, how much crypto they have. So they become very tied to that, and they got included in the NASDAQ 100. So they're only about a 0.4% weighting, about the 50th stock in the NASDAQ 100, but it is now a direct tie into the NASDAQ 100. So I think the correlation and the linkage is higher, and I don't like what I'm seeing in crypto, and I think that's going to continue to drag on stocks for the next few weeks.
So, Peter, we've had a little bit of a pullback here from the peak, call it 4% here. Do we have more to go, do you think, at least in the short term, until maybe the market gets a little bit more comfort with this administration and some of the economic policies?
Yeah, I do think we have more to come. We might get a little bounce today. We might get some good news out of Zelenskiy. Trump might say that delivering the cartel prisoners to the U.S. gets Mexico another stay of execution on tariffs. But I think we are going to go back almost across the board to pre-election levels. You've already seen that hit certain cryptocurrencies. I think Ethereum is back to levels from before then. It hasn't hit Bitcoin yet. I think that's coming. In the stock market, the Russell 2000's back pre-election levels. We're not there on the S&P 500 or NASDAQ 100 yet, but I think that's where we're headed, unfortunately.
Let's talk Fed. 2 cuts, I believe, are priced in right now, if the markets are correct. Is that enough?
I'm beginning to think not. I would say start of the year, I was thinking 1 to 2 cuts. I did not think we make much progress on the deficit. I'm still not sure we will make much progress on the deficit. Having said that, I do think the economy is slowing faster. And again, we just talked about some of the issues with tariffs and how I think we go through a bumpy patch. When you look at what DOGE is trying to do, it's going to cut some spending. That's going to hit immediately. Whether some of it was inefficient, fine, maybe that doesn't have an impact, but to the extent they trim anything that was efficiently being allocated, that hits. And then the jobs, even if people get laid off, are able to find jobs, which I'm questioning because I don't think the market's that great for jobs. It is still going to be this transition period. So I think we're going to see economic data hit across the board, and we're starting to watch delinquencies rise across the board. I think this economy is much more susceptible to a pullback than we have talked about for a while. So I think we're going to see 3 to 4 cuts this year, and we're going to start hearing the recession word rear its head again in the next few weeks.
Interesting. All right, given that backdrop, Peter, fixed income, how are you playing the bond market these days?
And I was bearish in the bond market. I thought we could get to 480. It wasn't aggressive, and we've been trying to time it. I've capitulated on that. I think the bond market, 4 to 4.25% on 10s, mostly because I really capitulated on the state of the economy. I thought we'd have a smoother transition with Trump. I think there'd be more clarity. It's the lack of clarity that's kind of confusing me. So I think yields are going to be okay. I think credit spreads start widening. I do like the municipal bond market for a lot of our clients, on the retail side of things when we talk about it. But as a whole, I think credit's going to be okay. I am, for the first time in, probably a year and a half, a little bit nervous about credit spreads. So I've been very calm about credit spreads. I think we're going to see some widening if I'm right on what's going on in the economy and further pullbacks in stock market.
Peter, thanks so much for joining us. Really appreciate it. Peter Tchir, he's head of macro strategy at Academy Securities here.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.